170%. That's the gain U.S. natural gas has seen in just the last year. It has been one of the best performing assets of 2024 and even broke out above a key resistance line dating back to November of 2023. But natural gas fell by 20%, wiping out all the gains seen in the beginning of 2025. Believe it or not, the release of DeepSeek's much cheaper and efficient AI model could be playing an important role here. Natural gas currently accounts for 43% of total electricity generation in the US, making it a key commodity. With the rapid adoption of AI, which requires significant amounts of electricity to train and operate models, natural gas has become an even more critical energy source. Currently, AI data centers consume 1 to 2% of global power. This figure has been projected to grow significantly. By 2030, estimates suggest power demand from data centers could increase by around 10% annually, potentially reaching up to 5% of global electricity consumption. And natural gas prices have risen substantially on the back of these exorbitant projections. But now, the release of the new Chinese AI model, DeepSeek, suggests that AI could actually be a lot more power efficient. Natural gas prices have declined as a result. So is the trade on natural gas actually dead? Well, electricity demand is just one side of the equation. We also have to look at natural gas supply to get a good sense of where price is going next. Natural gas production in the US has recently shown signs of leveling off, as you can see from this line that's been flat since the beginning of 2024, a stark difference from what we've seen since late 2021. But consumption has continued climbing during this period. This decline in supply, but rise in demand, is what's driving the recent rise in natural gas. And this gap between production and consumption can further close rapidly if AI significantly increases demands in the coming years. We can see that 2002, 2013, and 2021 all saw a decline in production with a rise in consumption, similar to today. If we look at what US natural gas prices were doing in each of those instances, they rose substantially. The relationship between supply, demand, and US natural gas prices is quite straightforward. When production, so supply, declines and demand remains constant or rises, natural gas prices rise. And when supply increases with demand declining or stagnating, then natural gas prices fall. This makes natural gas very cyclical in nature because of its production cycle. This cyclical behavior is quite visible on natural gas's price chart going back to 2008. So if we assume that natural gas is experiencing something similar today, we can look at the length of the prior cycles to get a rough idea of what could happen this time around. Between the 2020 and 2024 bottoms, there were about 200 weeks. Between 2016 and 2020, there were about 211 weeks. And between 2012 and 2016, there were 201 weeks. Notice a pattern here? These cycles tend to last somewhere around 200 to 210 weeks. Of course, each cycle does look very different in terms of price appreciation and volatility. And just because we're at the beginning of a move up doesn't mean we can't just see natural gas reverse lower much earlier than 200 weeks. That's what happened in the cycle from 2009 to 2012. It proved to be short-lived, lasting only about 136 weeks. If AI's energy demand significantly declines going forward, it could be that the current cycle ends up being shorter too. When we run a similar type of analysis for the peaks, we see that the peaks from 2018 to 2022 came 198 weeks later. The one from 2014 to 2018 was about 246 weeks apart, and 2010 to 2014 was 210 weeks. So if natural gas is following a similar 200 to 250 week range, like in the recent cycles, it could suggest that natural gas's next big peak occurs between June 2026 and June 2027, before high prices lead to excess supply and begin to pull the commodity back down again. While production cycles give you a broad idea of what to expect, demand is what really determines how high natural gas prices can go. Now, yes, there is increased expectations of electricity demand as a result of AI, as mentioned earlier. That only represents about 30% of natural gas usage. The other big chunk is from industry, and that isn't really benefiting from AI yet. One great way to look at demand from big industry is to look at the price of oil, the other big source of energy in that sector. Recently, oil prices did see a slight uptick, but price is still relatively low, indicating low global energy demand. It's clear that significant rises in global natural gas prices almost always align with upward movements in oil prices. The current environment, where global natural gas prices are rising while oil prices are generally declining, is not common. In fact, over the past 10 years or so, the growing use of liquefied natural gas, or LNG for short, has made the natural gas market far more interconnected than it was a decade ago. LNG cools natural gas into a liquid form, which can then be shipped in special tankers. Once it arrives at its destination, the LNG is turned back into gas and sent through local pipelines. This process lets natural gas flow between continents, making it possible for natural gas from the US to reach other continents across the globe. As LNG exports ramp up, the US market becomes more influenced by global supply and demand dynamics. According to data from the US Energy Administration, the US became the world's largest LNG exporter since 2023. This growing interdependence means that the global natural gas market is now increasingly impacting the US natural gas market. The current divergence between natural gas prices and oil prices has likely been driven by increased expectations of electricity consumption from AI. But as mentioned earlier, DeepSeek's new AI model suggests these estimates of energy requirements may have been too high. For global and US natural gas prices to continue their big bull run now, oil prices would need to start curling up, confirming that global energy demand is indeed moving higher. A recovery in manufacturing and economic activity, particularly in major markets like the US and China, could catalyze such an outcome. But if global energy demand and oil prices remain low, then it could pose a threat for natural gas prices. In the near term, if we look at the candlestick version of US natural gas and put the 100, 150, and 200-day moving averages on it, you can see that the commodity is trending higher. Right now, price is significantly higher than all three key moving averages that are still near the resistance line that price broke out from. But even during strong bull markets, like between 2020 and 2022, natural gas came back to test these moving averages multiple times. At Capital.com, we'll continue to provide updates on such market developments. You can trade natural gas and oil on the Capital.com platform. Thank you for watching.